Welcome to Beyond the Mortgage. I'm your host, Tracy Valko, and today I am thrilled to welcome Benjamin Tal. He is Chief Economist at CIBC World Markets and one of Canada's most influential and widely quoted economists. Benjamin will share perspective on where the Canadian market is heading and what that means for Canadians navigating their financial future. So let's dive in and learn from Benjamin's experience and expertise. Thank you so much, Ben, for joining me today. I have so many questions to ask you, but I know my time is limited, and I so appreciate your time, your conversation, but also your education, because there are so many people that admire and listen to you and really navigate their financing around a lot of information that you provide. So one thing that I want to talk about is at the Mortgage Professional Canada's conference this year, you discussed and mentioned about the per-capita recession and the ongoing economic uncertainty. So in your opinion, what do you feel are the biggest risks right now and suggestions for Canadian households to be able to navigate through these challenging times?
Yes, absolutely. The level of uncertainty is relatively high. We all know that, and we all know why. Clearly, the Trump situation is a major force impacting the psyche of consumers in Canada. In fact, I will make the point that one of the most significant factors impacting negatively the Canadian housing market is Trump, uncertainty about Trump, because if you're not sure about your job tomorrow, and we know that the unemployment rate in Canada is elevated, about 7%, you're not buying a house, regardless what interest rates is.
Absolutely.
So clearly, this is a factor that is impacting everybody. And yes, we are very close to a recession or a semi-recession, clearly a per-capita recession. Second quarter GDP was negative, third quarter GDP will be close to zero. So one accident and we are in a recession. The housing market is clearly slowing down, especially in places like Ontario and BC. I would say that in many ways, the housing market is in a recession, especially, of course, the condo space that needs another 2 years to clear. So this is a very difficult situation to be in, probably the most significant test that the housing market has seen since the 1990s recession. Let's face it, that's the way it is.
Absolutely.
It has been a very good 20 years, and now we are slowing down. But, Tracy, the fundamentals of the market are still very strong. If you ask me where this market will be 2, 3, 4 years from now, it will be actually relatively strong. We have to go through a process. So the trajectory is up, slowing down and continue to go up because we simply have a lot of demand in this country and not enough supply. So the fundamentals are very strong, but we have to go through this.
Yeah. No, absolutely. I think again, in challenging times, we see opportunity, right? So the one thing I wanted to dial in is on the Bank of Canada. So they recently cut their rate to 2.25. Do you expect further rate cuts? And also, what do you think about Canada's GDP? Do you think that the Bank of Canada will forecast that the remainder, like what will that look like for 2025 and 2026?
Yes, I have an issue with the Bank of Canada because I do believe that they have to cut, they have to continue to cut. Unfortunately, I don't think they will unless something big happens. We have to realize, and that's important when you discuss things with clients, to understand that the Bank of Canada's focus is really not the economy, but inflation. And inflation should be around 2%. And clearly inflation is a bit above that. But if you really look at the situation, if you measure it correctly, inflation is below 2%. I'll give you an example, and people in real estate definitely will be able to appreciate that. You know, the Bank of Canada, Stats Canada are telling us that still rent is rising by 4-5%. No way. You ask any person in the rental market, they will tell you that rent is actually negative in terms of inflation. And all those, developers and landlords give you 1 or 2 months for free. So de facto to rent is actually negative, but the Bank of Canada is still looking at it as positive, which means that we have a situation in which inflation is overstated, and that's the reason why the Bank of Canada is not cutting. We have to realize one thing. They made it very clear in their statement, which is very unique. Usually they don't do that. They told you we are done. And I think it was a compromise because many people in the Bank of Canada did not want to cut interest rates in October. Only a few wanted. And the compromise was, okay, let's cut, but let's tell everybody that nothing else is coming in the future. So from a planning perspective, unless something big happens, let's plan for relatively stable interest rates over the next 6 months, the short end of the curve and the long end of the curve.
And so with that conversation then, Ben, what do you forecast on housing pricing and also housing availability for Canadians over the next 12 months?
Yes, so let's talk about what kind of houses. So if you are in Toronto or Vancouver and we're talking about the condo market, the market is down by about 20% already. I believe it will continue to go by another 5 to 10% before we stabilize. We have a lot of inventory, especially in Toronto, that will take about 2 years to clear. However, we are building zip. We are building nothing, which means that 2 years from now, 2.5 years from now, the demand is still there, the inventory level will go down, and we have nothing in terms of new supply. That will lead to higher prices down the road. The only question is, will it take 2 years, year and a half, or 3 years? That's the only question. So if you are in the market for a condo, this is actually your time the next year because prices will continue to go down, will remain weak for a while, and then take off. If your time horizon is 5-10%, you will be fine. So that's the condo space. The low-rise segment of the market depends where you live. Alberta is doing fine. If you look at Eastern Canada doing fine. Clearly, BC and Ontario not doing fine at all. And although the situation there is not as bad as in the condo space, I believe that price inflation in the low rise of the market will be positive, but it will be 0 to 5% over the next year or two. Beyond that, I see it actually stabilizing and going further into 2030. So I think that we have a situation in which it will be a relatively soft market. It will be a buyer's market for another year or two, but then it will improve.
And then my last question for you, Ben, is mortgage renewals. It's such a hot topic conversation, continually educating my team in the communities across Canada how to navigate renewals. What do you think next year? We're going to have the most mortgage renewals, I think, historically ever with the banks and lenders. How do you think a homeowner should navigate with their renewal?
Yeah, so we have two things happening. One is interest rates are going to be higher. So everybody was worried about 2025, and I've been saying for a while the real test will be in 2026. So we estimate that about 5 to 6% of mortgage outstanding will face a payment increase of more than 40%. So 5 to 6% of total mortgage outstanding increase of more than 40%. That's significant. Very difficult to actually do. So I have no question in my mind that we'll see some increase in delinquency rates. However, another factor that is impacting clearly is the fact that if you look at 2020 versus 2025, prices in 25 were still higher than 2020. In Ontario and BC, in 2026, that's not longer the case. Basically, prices are below in Ontario, which means that in 2025, you had the option to refinance, and refinancing was a major force, leading to adding to originations. This window is closed for Ontario and BC in 2026, and that's why you will see more difficulties. Banks are aware of that. All the banks are aware of that, and they are not just going to sit there and do nothing. They will basically, and that's the way to navigate the situation. Go to your bank and say, listen, we have an issue here. The cost is rising by 40%. I cannot refinance. What can we do? And the bank will tell you, okay, why don't we increase your amortization? Well, let's do something. Banks are willing to play that game to ease the pain until you stabilize. So I think that's the way to do it. Go to the bank and say, listen, let's do something to ease the pain, and banks will go with 40 years or something that it will be a different category. It will be at risk category.
Or go to your mortgage professional, right? To take a look
Absolutely,
at that. Absolutely,
to take a look at that.
So,
exactly.
And I guess my bonus question kind of into that, because I was thinking the big conversation that Trump put out last week is about reintroducing a 50-year amortization. Now, again, I know that's something that we probably won't be seeing here in Canada, but do you think an actual extension of the amortization over 30 years is possible on the A side?
Absolutely. I think that it will be possible, especially for people at risk. So I don't think it will be across the board, but people at risk. And that's why, Tracy, you are working with your clients and you can identify those options. Because I think that, quite frankly, until now it was very easy, auto remote. I think that it's going to be much more difficult. You need the professional help in this environment.
Thank you so much for your time. I appreciate the education. I love our conversation, and I'm looking forward to speaking to you in the new year. And fingers crossed, the market gets better and we rebound.
All the best. Thank you very much. My pleasure.
Thank you for tuning in to Beyond the Mortgage. I hope you enjoyed today's episode with Benjamin Tell. Remember, knowledge is your best investment. Keep moving forward and never stop building your best financial future.